Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is CFPB Finalizes rule significantly restricting credit card late fees, rulemaking, litigation, and secondary market update. My name is Eric Mitzenmacher. I'm a partner in Mayor Brown's financial regulatory practice based out of our Washington, D.C. office. My practice primarily involves providing program development and day-to-day compliance advisory services to non-mortgage consumer and small business credit programs, including credit card issuers, as well as conducting compliance reviews of such programs on behalf of investors and financing sources. Joining me today are Mayor Brown partner Jan Stewart and Mayor Brown associate Joy Tsai. Jan is a partner in Mayor Brown's structured finance practice based in our Chicago office. Her practice is broad, but includes, as relevant to this discussion, substantial focus on credit card programs and credit card receivables securitizations and financing transactions. Joy is an associate in Mayor Brown's financial regulatory practice based primarily out of our San Francisco office. She works with me and other of our financial regulatory partners on a wide range of non-mortgage credit programs, including providing program build-out and regulatory review services in connection with consumer credit card programs. With that said, let's begin on the substance. Over the course of this discussion, we will address the CFPB's final rulemaking, a challenge to the rulemaking's validity currently making its way through the federal courts, and the impact or potential impacts of the rulemaking on the secondary market for credit card receivables. Before we get too engaged with the rulemaking itself, I will spend a few minutes laying groundwork regarding the current state of federal restrictions relevant to credit card late fees. This background is intended to provide context to the rule-specific commentary that follows. Effective in early 2010, the Federal Truth in Lending Act was amended by the Credit Card Responsibility, Accountability, and Disclosure Act of 2009, or CARD Act. The CARD Act imposed a variety of new disclosure requirements and substantive limitations on consumer credit and charge cards. Among other requirements, the CARD Act imposed new restrictions on penalty fees charged by card issuers. A penalty fee would be any charge imposed on a cardholder for a violation of account terms, including not only late fees, but also fees such as NSF fees and fees for exceeding an account's credit limit. Such penalty fees could only be charged if they were reasonable and proportional to the violation of terms giving rise to the penalty. The limitation applied to traditional credit cards and charge cards, but not to business purpose credit cards, whether issued to a business entity or natural person, to credit cards accessing individual extensions of closed-end credit, as seen in certain specialty home improvement and retail financing contexts today, or to credit cards accessing HELOCs. For cards to which the rule applied, in addition to the general rule requiring reasonable and proportional penalty fees, the CARD Act also required rulemaking to establish standards for reasonableness and proportionality determinations. The rulemaking, initially issued and administered by the Federal Reserve Board, but later transferred into the CFPB's authority, was required to consider certain factors, including the cost incurred by the creditor from the account violation leading to the penalty fee, the deterrence effect of the penalty fee, the cardholder's conduct in incurring the penalty fee, and any additional factors the regulator deemed necessary or appropriate. The CARD Act permitted differentiation among fee types in the required rulemaking, though the initial rules adopted by the Federal Reserve Board largely were agnostic to the type of fee involved. They did establish a separate structure for charge card late fees, but that is not at issue in the CFPB rulemaking and will not be discussed further on this call. The Card Act also provided that the regulator could establish a safe harbor value for any penalty fee that is presumed to be reasonable and proportional. Effective in August 2010, the Federal Reserve Board issued its final rulemaking implementing the penalty fee provisions. The rulemaking laid out a set of analytical and documentation standards a card issuer would have to follow to support a reasonable and proportional late fee. It also established a safe harbor structure, $25 for the first penalty fee for a given type of account term violation, and $35 for any subsequent penalty fee for the same violation within a 6-month period. Each of those would be adjusted annually for inflation. Finally, the initial rulemaking established a second cap on penalty fees, specifically that notwithstanding any general reasonableness or proportionality standards, no penalty fee could exceed the amount of the account violation to which the penalty related. For example, a late fee imposed for failure to pay a minimum required periodic payment when due could not exceed the amount of the minimum payment. As time passed from the Federal Reserve Board's initial rulemaking, it became clear that the operational burdens imposed to support a reasonable and proportional penalty fee in excess of the safe harbor value were substantial. Accordingly, the vast majority of card issuers, potentially all of them, though I hesitate to make such an absolute statement, chose to impose penalty fees at or under the safe harbor values. In addition, over time, the annual inflation adjustments for safe harbor fees moved the values from their initial $25-35 structure to values of $30 and $41 respectively, immediately prior to the current rulemaking. With that groundwork in place, Joy, could you discuss the CFPB's new rule?
Sure, thanks, Eric. So the CFPB issued its final rule on March 5th, 2024, that would restrict late fees that most credit card issuers may charge. This amount goes from $30 for the first violation or $41 for subsequent violations to a flat $8 for all late payments. This final rule follows the CFPB's proposed rule that came out in February of 2023. And this final rule has adopted much of the content from the proposed rule. The final rule would be effective starting May 14th, 2024, and there are 3 key components to it. First, the final rule would reduce the basic safe harbor limit for credit card late fees from $30 to $8. Second, the final rule would eliminate the distinction between first and subsequent violations for late fees, such that the $41 safe fee harbor for subsequent late fees would no longer apply. And third, the final rule eliminates the automatic inflation adjustment to the $8 safe harbor limit. Just as before, instead of relying on the safe harbor amount, credit card issuers may still impose fees that represent a reasonable proportion of the total costs incurred by the card issuer. The final rule clarifies that this calculation should not include any collection costs incurred after an account is charged off as part of that calculation. However, as Eric mentioned, practically speaking, given how conducting such a cost analysis would require substantial procedural and examination burdens, we believe virtually all card issuers have relied on the safe harbor limit instead of conducting this cost analysis. The final rule includes an exemption for what it calls smaller card issuers, who would not be subject to the reduction of the safe harbor limit for credit card late fees. The final rule defines a small card issuer as a card issuer who, together with its affiliates, has fewer than 1 million open credit card accounts for the entire preceding year. However, the final rule would cover approximately 95% of all credit card balances. The CFPB estimates that the final rule would save about $10 billion per year for consumers. It has reached that amount by saying it would be $220 per year for the approximately 45 million consumers in the US who are charged credit card late fees. Credit card issuers believe that this reduction in late fees would result in an increase in late payments. I'm going to move on and briefly touch on the procedural history of the litigation that has occurred since the CFPB issued the final rule. We emphasize that this is a pre-recorded session and there will definitely be updates after today, April 3rd, 2024, which we will continue to monitor. Since the final rule was so similar to the CFPB's proposed rule back from February 2023, it's not entirely surprising that a group of trade organizations were able to file a lawsuit immediately against the CFPB on March 7th, challenging the rule. The plaintiffs include the Chamber of Commerce, the American Bankers Association, the Consumer Bankers Association, and the Texas Association of Business. They filed a lawsuit in the Northern District of Texas. The CFPB filed a motion to transfer venue from the Northern District of Texas to the District Court for the District of Columbia. The court granted the motion on March 28th, noting that 3 of the plaintiffs, as well as the CFPB, are located in DC, and the final rule was promulgated in DC. The plaintiffs appealed, and the Fifth Circuit stayed the transfer to allow plaintiffs additional time for filings. And as of yesterday, Tuesday, April 2nd, the Fifth Circuit has extended the stay of transfer until 5 p.m. this Friday, April 5th. So currently, this lawsuit appears to be stuck in the venue determination process before any determination of substantive issues. We note that earlier on March 7th, the plaintiffs also filed a motion for a preliminary injunction. They argue that the credit card industry faces immediate, serious, and irreparable harm as a result of the final rule. Given the May 14th effective date, as well as existing Regulation Z requirements for card issuers, the credit card industry would have to act immediately to meet compliance obligations, which would include updating, printing, and distributing to any banks and retail partners materials disclosing the late fees. The court issued an order setting April 2nd for the hearing on the preliminary injunction, and the plaintiffs filed a notice that they are appealing to the Fifth Circuit for what they deem effectively a denial of their motion for a preliminary injunction. As of now, regardless of where venue is set, the initial issue would be whether there would be an injunction on the rule. And arguments on the validity of the rule would take longer, and we continue to monitor for any updates. I'm going to pass this back to Eric to discuss about the substantive grounds for challenge.
Thank you, Joy. The substantive grounds for challenge include 3 distinct claims. The first set of claims is that the CFPB failed to adhere to requirements of the Administrative Procedures Act because they use certain information that is unavailable to the public in making their rulemaking decisions. The specific information was certain credit card portfolio data that banks file with the Federal Reserve on a periodic basis. This is examination data that is not available to the general public or published in the CFPB's rulemaking other than in summary form. As a result, the plaintiffs claim that the ability to comment and present meaningful substantive feedback to the regulator was compromised. Second, the plaintiffs claim that the CFPB failed to take into account all of the required factors laid out by the Card Act In particular, the CFPB allegedly gave relatively short shrift to the determination that any particular safe harbor value would serve as an effective deterrent for cardholders otherwise making late payments. While the Card Act is relatively flexible, permitting regulators to consider factors beyond those listed in the statute, it does on its face require specific consideration of the factors previously discussed. That is, the cost incurred by the creditor, the deterrence effect, and the cardholder's conduct in incurring the penalty fee. Finally, the plaintiffs raise a claim that the CFPB as a whole is unconstitutional as a result of its funding structure. This is a claim that is currently being litigated at the Supreme Court. Its inclusion in this case likely was an attempt not only to include it as a substantive claim, but also to support the potential for injunctive relief in the short run while the status of the CFPB remains uncertain. Each of these claims will be litigated more thoroughly, and as Joy mentioned, we will continue to provide updates as the litigation proceeds. With that said, I'll pass the mic to Jan for a discussion of secondary market implications.
Thanks, Eric. I'm Jan Stewart, a partner in the Structured Finance Group at Mayer Brown. I represent a number of credit card securitization issuers and lenders to credit card ABS platforms and wanted to share some potential impacts that the implementation of the late fee rule may have on these structures. Most credit card issuers are not waiting until the results of the litigation that Joy and Eric described are known. They're taking proactive measures to ensure not only compliance with the new rule, but also what impact the rule will have on financing structures, and intend to minimize those impacts. First, many of the financing transactions have excess spread triggers that would result in early amortization events if the cost of the debt service, servicing and trustee fees, and defaults exceed the amount of finance charge collections received on the portfolio in any given period. With rising interest rates on loans and notes that have occurred over the past year, the loss of additional collections may be problematic in maintaining these ratios, especially for credit card issuers with subprime or near prime portfolios, where the revenue derived from late fees has historically been more than a de minimis amount of their overall collections. These issuers may look to use other tools in the financing structure to boost the excess spread calculation. One of these features is the ability of the financing issuer to discount principal receivables that it acquires, such that a portion of the collections received from repayments of principal charges on an obligor's credit card account is recharacterized to be finance charge collections. Quickly turning on this discounting feature is more challenging for legacy credit card master trusts that still require compliance with a no longer effective accounting standard, FAS 140, to support its bankruptcy remote status under the FDIC safe harbor rule. Those issuers are exploring other means to support their excess spread calculations. Credit card originators may also look to boost income and fees available for its financing structures by offering new products related to the credit card account, such as debt protection plans. Fees related to these new offerings can be transferred along with the related receivables into a securitization and may be included in the excess spread calculation. Another way the credit card issuers can increase the excess spread percentage is to minimize defaults and charge-offs in their finance portfolio. The desire to originate higher quality receivables could result in a further tightening of the credit box related to the qualifications necessary for an obligor to obtain a new credit card account or for existing obligors to increase their credit line. The CFPB's late fee rule could have the unintended consequence in making it more difficult for consumers to secure credit. We do note that the CFPB's late fee pronouncement did not result in a halt to the credit card ABS market. Several capital market issuances have proceeded and are contemplated despite the uncertainty regarding the rule's implementation and the related litigation that Joy described. In order to proceed on the issuer's timetable, credit card ABS issuers have needed to develop disclosures to include in the prospectus or other offering documents that describe the changes imposed by the rule and the possible results of the pending litigation. We will continue to monitor this litigation and expect further updates in the coming months as the litigation makes its way through the court process. Therefore, the disclosures that these issuers use will continue to evolve. And now I'll turn the mic back to Eric for some concluding remarks.
Thank you, Jan, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.